decided to reduce the repo rate by 25 basis points to 7.5% to continue supporting the domestic economy while simultaneously safeguarding the peg between the Namibia dollar and the South African rand. The decision was made following a comprehensive review of domestic, regional, and international developments. Let us consider recent economic developments in Namibia. The Namibian economy recovery continued during the first 6 months of 2024, although growth is forecast to decelerate for 2024 as a whole. Inflation continued to moderate while the growth in private sector credit extension remains subdued. The merchandise trade deficit widened further while the stock of international reserves remained sufficient to support the currency peg and meet the country's international financial obligations. Domestic economic activity rose during the first half of 2024 relative to the same period in 2023. However, growth is expected to slow in 2024. While the increase in economic activity during the first half of the year was broad-based, it primarily emanated from the mining, electricity generation, wholesale and retail trade, tourism, communication, and transport sectors, as well as the livestock marketing subsector. Looking ahead, growth in Namibia's real gross domestic product is projected to decelerate to 3.1% in 2024, from 4.2% in 2023. This revised projected growth is 0.6 percentage point lower than the forecast at the previous MPC meeting. The slower growth is anticipated to be mainly driven by a slowdown in the primary industry, partly reflecting the prevailing drought conditions. Risks to the domestic economy, stemming from both external and domestic factors, have remained broadly unchanged since the previous MPC meeting. The external risks include unduly tight global monetary policies, disruptive geopolitical tensions and conflicts, as well as geoeconomic fragmentation. Mounting unfavorable developments in the international natural diamond market present an additional adverse external risk to domestic growth. Internal risks remain the persistent drought conditions and water supply interruptions, particularly at the coastal towns. Domestic inflationary pressures have continued to ease year to date. On average, inflation slowed to 4.8% during the first 7 months of 2024, from 6.2% recorded during the same period in 2023. The disinflation continued to be primarily driven by a relatively lower average food inflation. Since the last MPC meeting, inflation eased from 4.9% in May to 4.6% in both June and July 2024, mainly reflected in the categories of alcoholic beverages, tobacco, and transport. Going forward, the forecast of average inflation for 2024 and 2025 have been revised downwards to 4.7% and 4.4% respectively, compared to previous projections of 4.9% and 4.5%. The downward revision to the inflation forecast is attributed to the appreciation of the Namibia dollar and the moderation in crude oil prices. Since the previous MPC meeting, annual growth in private sector credit extension has exhibited some volatility while remaining subdued. Private sector credit extension growth rose from 1.6% in April 2024 to 3.2% in May 2024, before falling to 1.8% in June 2024. Meanwhile, the growth in private sector credit extension slowed to 2% during the first half of 2024 compared to 2.8% recorded in the corresponding period in 2023. Overall, PSC growth continues to be restrained by tight lending conditions amid eroded real incomes and a restrictive monetary policy. Namibia's merchandise trade deficit widened to 19.9 billion Namibian dollars during the first half of 2024, compared to 12.3 billion in the same period in 2023. The wider trade deficit was primarily underpinned by high import payments in the categories of machinery, equipment, and base metals, largely due to increased exploration activities. The higher deficit was further exacerbated by a decline in export receipts attributable to lower diamond exports, largely reflecting the depressed diamond prices. The stock of international reserves as at the 31st of July 2024 stood at 60.8 billion Namibian dollar, higher than the level of 55.6 billion recorded on the 31st of May 2024, mainly due to higher SACU receipts. This most recent level translates to an estimated import cover of 4.1 months, remaining adequate to sustain the currency peg between the Namibia dollar and the South African rand and meet the country's international financial obligations. Let's then consider the global picture. Global economic activity continued on a gradual expansion path during the second quarter of 2024, with growth expected to remain broadly stable in 2024 and 2025. While inflation recently exhibited a mixed picture, it is significantly lower than a year earlier. The monetary policy easing cycle has commenced, even though most monitored central banks continued to exercise caution regarding interest rate reductions. Global economic activity has demonstrated resilience since the last MPC meeting, partly due to improved global trade, easing financial conditions, and relatively lower inflation. Available second quarter output data indicates that growth improved in the United States and the euro area, but moderated in China. Going forward, the International Monetary Fund projects a broadly stable global economy, with growth moderating from 3.3% in 2023 to 3.2% in 2024, before edging up slightly to 3.3% in 2025. The 2025 forecast represents a modest upward revision of 0.1 percentage point compared to the April 2024 projection. Prices of most key commodities have declined since the last MPC meeting. Diamond prices continue to trend downwards on the back of weaker global demand, especially in the United States and China. Zinc and copper prices also fell, driven by weaker demand from China and higher global inventories respectively. Likewise, the uranium spot price has fallen from its peak at the beginning of 2024, but remains elevated due to the global commitment towards cleaner, safer, and more secure energy sources. Conversely, the price of gold continued to rise, supported by safe haven demand. The price of Brent crude oil rose up to early July 2024, partly due to supply cuts by the Organization of Petroleum Exporting Countries and heightened tensions in the Middle East. Most recently, however, the price of Brent crude oil fluctuated downwards to levels slightly below those at the time of the previous MPC meeting. Food prices, as measured by the United Nations Food and Agricultural Organization Food Price Index, ticked up in July 2024. Underpinned by a robust demand for meat and seasonal supply shortages of milk and sugar. Global equity markets generally trended upwards in the first 4 weeks after the previous MPC meeting. Excuse me. But some key equity markets then experienced significant pullback since the middle of July 2024. Driven by valuation concerns, profit-taking, particularly from big technology companies, softer economic data, and divergent monetary policies, some key equity markets experienced steep declines during the first week of August 2024, but recovered some of the lost ground thereafter. The volatility of key bond and equity markets also rose sharply over the same period, reflecting high economic uncertainty and geopolitical tensions. Trends in global inflation have been mixed since the June 2024 MPC meeting. In the advanced economies, inflation remained steady in the United Kingdom, the Euro area, and Japan, while it declined in the United States. Among the monitored emerging markets and developing economies, inflation rose in Brazil, China, and Russia, but receded in India and South Africa. Global inflation is, however, generally cooling off compared to 2023 and is expected to continue its downward trajectory in 2024 and in 2025. The pace of disinflation is now anticipated to moderate over the forecast horizon due to the expected persistent service price inflation, particularly in the advanced economies. Most monitored central banks have continued to remain cautious about cutting policy rates, primarily due to lingering inflation. But the monetary policy easing cycle has started in some monitored economies. The Bank of England and the People's Bank of China have recently cut rates following the ECB earlier on, while the Bank of Japan and the Bank of Russia raised policy rates at their latest monetary policy meetings. So what is our monetary policy stance? The MPC observed that despite the gradual global disinflation, most monitored central banks have remained restrictive, even though some have taken the first step in easing monetary policy. In Namibia, economic activity remained on a recovery path, but with a lower growth rate forecast for 2024, in part due to drought-induced setbacks. There has been a welcome slowdown in inflation. Private sector credit extension has been weak for a protracted period, and the domestic economy in aggregate was also deemed in need of essential support. With inflation and inflation expectations slowing and nominal interest rates unchanged, real interest rates have increased, thereby signaling an effective tightening of monetary policy. International reserves remain adequate, have in fact increased further. Considering these factors, the MPC felt that a moderate easing of monetary policy was warranted. Consequently, the MPC decided to reduce the repo rate by 25 basis points to 7.5%. Commercial banks are accordingly expected to reduce the lending rates by 25 basis points and to speedily transmit the interest relief to borrowers. The bank's prime lending rate will therefore decline from 11.5% to 11.25%. This policy stance will continue to support domestic economic activity and safeguard the one-to-one link between the Namibia dollar and the South African rand, supported by the adequate stock of international reserves. The MPC has the view that as the monetary policy cycle progresses, easing cycle progresses, the margin between the repo rates of the Bank of Namibia and the South African Reserve Bank will again narrow. Thank you for listening. This time around, I've been requested that some colleagues actually would like to get the statement in a language that they understand properly. So please bear with me so that we can do a presentation that hopefully will give a bit of color on some key developments, on the decision, on how the economy is performing. And if you see it as a duplication, please bear with me, because some of our colleagues are saying we need a little bit understanding in a layman's language what you have decided. So here's our attempt to give a bit of color and try and communicate to all people that are following us online. What did we decide today? We reduced the repo rate by 25 basis points to 7.5%. We still understand that interest rates remain high, but we remain focused on our mandate. Our mandate is to ensure that inflation stays low and that the value of the Namibian currency is protected. Over the past 18 months, we had a restrictive monetary policy, and that was put downward pressure on inflation. And you could see that inflation is coming down from the numbers that I've quoted. We'll give a little bit of more numbers later. At a high level, we're trying to summarize what we have decided. How is the Namibian economy performing at a very high level? Real gross domestic product growth is expected to slow. We said we are doing well over the past 6-8 months, but the growth rate is slowing down. So the economy needs some support. So that's quite important. Many people are saying, but you are saying over the past 6-7 months, the economic growth activity is doing well. But the growth rate is actually slowing, and we're actually forecasting growth for 2024 as a whole to be lower, and I'll provide you some figures later. Our diamond industry is not doing well. We'll get into the reasons for that later. Our construction sector continues to struggle, but it should pick up this year on the back of two big things. One, the development budget that was approved by the Minister of Finance of 12.6 billion Namibian dollars. Some new mines that are starting up is going to help. And there are some exploration activities that's also going to help with some construction. Let's look at the Namibian underlying inflation and try and understand why we need to get a handle on this. Our mandate is to make sure that the prices don't run out of control. So domestic annual inflation remains steady at 4.6% in July 2024. And in June 2024. So it was in June 24, 4.6, and in July it was also the same figure. The biggest contributors were food and non-alcoholic beverages, about 1%, alcoholic beverages and tobacco, housing, water, electricity, gas, and a reduction in transport. So that has contributed to bringing the inflation down. If you look at the goods inflation, it slowed to 5.3% in July from 5.8% in June 2024. While services inflation rose to 3.4% in July from 2.9% in June. Most categories in the inflation basket remain stable and edge downwards. Food is the one we've seen the big contributors. Transport is coming down, food is going up, but overall inflation is coming down. So what do we forecast inflation to be over the next 3 months? We said in July it will be 4.6%. We believe that it's going to slightly edge up in August to 4.7%, in September 4.6%, in October this year, it will come down to 4.5%. So if we look at baseline estimates about what inflation will be doing in 2024 and 2025, the forecast is an average inflation of 4.7% in 2024 and 4.4% in 2025. 4.7% on average in 2024 and 4.4% in 2025. We also realize that loans are still expensive. Many people are saying that the Bank of Namibia, do you realize that interest rates remain, it's still expensive. High interest rates mean loans are relatively expensive, but it's becoming easier with today's decision. It's not there entirely, but Namibians have been used to interest rates of around 3 to 6%, and you know what we have got now, it's numbers that are beyond what most of our colleagues expected. And that's the first time that interest rates are reduced since mid-2022. Let's look at real sector developments. So what do we think is going to happen to the Namibian economy in 2024? We believe it's going to slow down to 3.1% before it's picking up in 2025 to about 3.9%. Why is it going to slow down, and why does the economy need some support? It will be driven by slow global demand. We've got drought in the country, and we see that our diamond industry is struggling because of global consumer demand. So if you look at what are the risks to the growth to our economy, you'll see that there are both domestic factors and there are external factors. And the mounting geopolitical tensions in the Middle East, we see what is happening in Gaza, what's happening in that part of the world in the Middle East. It could lead to some supply chain challenges. It could have higher shipping, higher freight cost. The subdued property sector in China also poses a major risk to global and domestic growth because China is importing commodities from countries like Namibia. So if the economy in China is not doing well, clearly we'll have challenges with growth in the Namibian economy. We have got depressed diamond prices and increased pressure from synthetic of lab-grown diamonds. We've got drought, we've got water supply constraints in coastal towns in our country. Those will have an impact on growth in our country. That's why we are projecting growth of 3.1% in 2024, and it's going to pick up to around 3.9% in 2025. Let's just give you the highlights. Obviously, there is a lot of information behind this. But if you look at domestic economic activity slowed and increased in the first half of 2020, showed an increase in the first half of 2024 compared to 2023. And it's quite important. But for the entire 2024, we forecast it's going to come down. Inflation slowed to an average of 4.8% during the first 7 months of 2024 compared to 6.2%. So you can see that it came down from the 6.2% we had in the first 7 months of last year to 4.8% for the 7 months of this year. If you look at the credit markets, credit extension remained weak during the first half of 2024, driven by lower demand and net repayments by businesses. If you look at our external sector, the merchandise trade account, that has deteriorated further during the first half of 2024, while our foreign reserves stood at about 60.8 billion at the end of July 2024. Our research colleagues have actually come up with quite important themes this time around, which I think is quite important that we need to share with our colleagues. They said, when deciding on monetary policy, MPC members think about the dreaded Ds. And these are what they have put out there for us to understand. On the diamond market, we are experiencing challenges. and there is a protracted recovery in diamond, and the demand and high inventories in the midstream. The two biggest markets for diamonds, the US and China, and the demand from those markets for diamonds are actually quite subdued at this stage. We have got high inventories, so it will affect production. Do you go and produce, or do you rather preserve cash? So diamond production will be affected. Taxes to government will be affected. That's coming from diamonds, and export revenue will be affected. On the drought, we know we're going through a difficult time. The president has declared drought as a national disaster in May this year, and the impact is becoming pronounced. We've got poor harvest, we've got poor grazing conditions. Our dam levels are very low. I'll put up a picture now so that you can see how dam levels are looking. And food insecure households have increased. The number of people that are food insecure have increased. On the disposable income side, we need to understand that although inflation has eased, prices remain elevated. And that's a big distinction. People say, you have decided to bring it down to support us, but the prices remain elevated. We agree with you. If we don't do anything to help you, maybe it's going to be more difficult or more challenging. High interest rates resulting in high debt service costs for households, negatively impacting credit uptake. On the positive side, there's quite a lot of relief measures that has come up. We know that the Minister of Finance have announced some tax relief. The old age grants have been increased, although not to the level that some people have expected. It's been done to assist the people in the country. Civil servants have received some salary increases. Repo rate is reduced to about by 25 basis points. So if you put all these together, some would argue and say, that could stimulate the economy and could have inflationary challenges. It's a big debate that we need to have around these. How do we assist people to go through this challenging time? The other D is the debt service cost. Debt service costs remained elevated. Debt remains elevated given the slowdown in gross domestic product. Redemption of maturing instruments between 24 and 25 is to increase public sector debt servicing. But there is a plan in terms of how to deal with government debt that I'm not concerned about at this stage. So quite a lot of activity that's happening in the uranium sector, apart from the diamond sector. Uranium output growth is projected to decrease to 3.6% from the previous 24.5% in 2023. But the long-term outlook for the market remains positive. The industry's future appears promising due to the following conditions. That's a rebound in uranium prices. That's a reopening of previously dormant mines. You know about Langenheinrich. You know about activities from Banneman, a Tango mine. It's a geodeep mine at Tumas mine. So a couple of activities happening in that space. There's also development of the new large-scale mines, the ones that I've mentioned, it's probably the big ones that's going to come up. The dam levels remain generally low because of drought. If you say the effects of drought is becoming pronounced, we can also see the big dams, those ones in red versus last year this time. The Hartab next to Marienthal is 9.5% full. One up next to Repo is about 38.5% full. Danfaljoen, 1.3. Ochivero, 3%. Negerdal is 81% still. Korengap Dam remains at 100%. But overall, you can see the dam levels are very low. And we have got a number of people that have become more food insecure. Real turnover in the wholesale and retail trade sector, you could see that has improved for the first 6 months of this year to 7.5% compared to 4.6% in the same period last year. You see, Namibians are buying quite a lot of clothes still. If you look at what happens for the first 6 months of this year compared to first 6 months of last year. Furniture, we also buy a lot of furniture. The first 6 months of this year is about 12.5% versus 1.7% last year, same period. The number of vehicles sold has declined. So we sold about 6,300 vehicles during the first half of this year, 6,300 new vehicles. And that's about 1.1% reduction or decline on the same period of last year. It's lower than last year. The reason that we understand is scarcity of some vehicles, affordability issues, the prices of vehicles become quite expensive. Interest rates are still high for us to pay back. So that's why you see a reduction in new vehicle sales in the country. Activity in the transport sector rose, driven by road and sea cargo volumes. You could see that overall cargo for the first 6 months of this year has increased by 9.2% versus 2.2%. Sea cargo has increased significantly, road cargo has increased significantly, but railway cargo, that has declined by about 19%. If you look at tourism activity continued also further during the period under review for both international and regional arrivals. It has increased by about 16.8% for the first 6 months of this year. If you compare it to the pre-COVID period, it's still below the pre-COVID levels. We have got some room. We can get more tourists to visit our country, both from the region and from the rest of the world. The occupancy rates increased marginally from about 44%, slightly from 44% to about 48%, for the first 6 months of this year compared to the last 6 months. It's a big disappointment is really credit extension, private, is slow and is subdued, as you can see. It was in April 1.6, now in June it's 1.8. Last year, June, it was 3 in terms of growth. So private sector credit extension is not where it should be. It's really slow. It's volatile and it's slow. In terms of the reserves that we have got for our financial obligations, you could see it remains adequate. As you have seen, we've seen a figure of about 60 billion at the end of July. In terms of import cover, in terms of the statement, I said it's 4.1 months import cover. If you exclude the exploration activities, you get to about 4.8, 4.9. It's in the statement. Right. So in conclusion, the domestic economy grew further during the first month because of increased economic activity in most sectors, but the growth is slowing down and is estimated 3.1% in 2024 due to the expected slower growth in the primary industry. Inflation continues to slow and is expected to average 4.7% in 2024 and 4.4% in 2025. Growth in private sector credit remained weak due to lower demand for credit given elevated interest rates. The merchandise trade deficit weakened during the first half of 2024, while the stock of international reserves rose and remained adequate to support the peg.